In this video, I'm going to talk about the trading strategy that's an explosive breakout strategy with a confirmation using Bollinger Bands. Stay tuned. Hey traders, a very warm welcome to you. Okay, so this is another swing trading strategy I have found for you. I like this one, it's good. Stay tuned for this one, this is a good one. Okay, so the theory behind this is that you are structuring your trade by saying, okay, we get a breakout of support and resistance, so pretty standard kind of support and resistance play. In other words, you know, multiple tags of a level, key level, whatever it may be, and we're combining that with a volatility expansion, and we're checking that volatility expansion by using a Bollinger Band. So I've got a 240-minute chart here on the pound yen. I've got a standard Bollinger Band setting 20 period, 2 standard deviations. I've also got another example for you in a second on a daily chart with gold. So it's pretty versatile, this bad boy. So let's get on and look at it. All right. So we have a setup here, and the setup is this. We have a support level on our pound yen around here, and the first criteria is we've broken below that support level, right? Remember, we're saying that's the first part of the criteria. The second part of the criteria is that admittedly we've only just do it, and again with all these trades, guys, if we drew that exactly on the low there, it still has broken through. It's close, but it still has broken through. I mean, I'm using it as the double bottom type setup, and it's a bit of a fuzzy zone. As with all these things, you've got to give it a bit of flexibility. There's always going to be a grey area somewhere in there, but it has actually triggered as part of the rules, so let's carry on with it. Broken below the support level, 1, check. Now the next part we're going to look at is that it's closed below a Bollinger Band, or outside, should I say, of the lower Bollinger Band. And if we look here, you can see the Bollinger Band is running down there, and we've closed outside. So we've got a criteria for a trigger for a trade here. And the theory is we're taking the entry on the close of that candle. So we're going short here. What's the close of the candle? Top of your screen there, 142.19. Okay, and as with a lot of these things, they're a bit vague with your stops and target criteria. For me, it makes perfect sense to have your stop above the high of the day, or the high of that candle that triggered it. So our stop is going to be up here at 143.41 ish. So we're in at whatever the close was, about 13.41. So you know, it's not a massive stop, obviously, depending on the time frame you're trading, and again, stuff that you can tweak to suit your objectives, your risk tolerance, that kind of thing. But to me, it makes sense doing that. And targets, you're looking at, I guess, many multiples of that, or a target that you've got from prior analysis, from prior charting. Don't forget, guys, that this is a strategy that's trying to get you in on the break of momentum, and it's giving you an extra confirmation. So not only do you get the support break or the resistance break, and preferably you're going to do that with the trend, with the larger trend. So not only do you get that, and you get the close below, so you get a couple of things there, but you also get the fact that it's expanded outside of the Bollinger Band, indicating a volatility expansion, generally indicating a lot more participants getting involved in it. So add all those together, and you've got what could be argued as a good reason to take the trade. In this example here, you know, we've got there's a lot of mileage in this. This one's moved kind of 500 points in our favor, 500 pips in our favor, and regardless of pretty much where you put the stop, it looks like a nice enough trade, doesn't it? So good thing, recap on that. You've got to break the support first. We've done. You've got to close below the lower Bollinger Band. We've done. You're going short there. Your stop is, you know, kind of above a cluster of highs if you want, or above the high of the day, or above the high of the candle, should I say, that triggered it. Either or. And then again, targets, multiples of your risk if you prefer, or some kind of target that stood out. Maybe the 140 level would be a sensible kind of whole number target for you. Maybe when you saw the gap lower on there, you're out straight away. Whatever. That's where your skill comes in with this. Anyway, let's look at gold, guys. Gold, there's a trigger on this as well. A very clean one, very nice one. I'm seeing resistance here at this kind of 1300 or 1296 level. Don't forget, this is an adjusted chart for CFDs and spread betting. So, but generally most people are going to be trading off this kind of spot chart, if you like, but it's close enough for what we need it for. We've got a high here, we've got a high here, we've got a high here. Eventually we break through on this candle here. Through we go, and we close above the upper Bollinger Band. We're closing at 1310, the upper Bollinger. I haven't got it tagged on here because of space, but it's definitely closed above it. So it doesn't matter what the price is, the fact it's triggered. And you know, if we're using the rules that we talked about, we're going to have our stop below this low here, where the low is 12.91. We're going to be at 13.10. We nearly get stopped out actually, but you know, nearly get stopped out doesn't matter. The whole point with a stop is, even if you want it at a point where you're not going to get triggered, but it doesn't matter how close it comes. The point is, it's not triggered. So we don't worry about that. We're in. And in this case, this thing has got an extra $50 in our favor, or $45, $47 in our favor before coming back. So many multiples of our risk, is it almost? Not quite. 13.10 on the lowest. So 20. It's a couple of multiples of our risk, and it makes kind of sense. And let's look at this, the actual theory of the trade behind the setup. So the resistance is there, 13.10, tries to break through. You don't get in on this fake out because it hasn't closed above. So it's quite nice from the strategy perspective, keeping out those fake outs. Eventually it does, closes above. You're long, your stop's in place, and you're looking for whatever target that may be, whether it's multiples of risk or some sort of premium that you've got from your analysis. Maybe you've got a fib extension if it's an uptrend. Maybe you've got a prior high or something if it's approaching a previous high level or low level, something like that. But I like it. I think it's quite a good strategy. Keeps you out of the rubbish stuff, keeps you in the very best stuff. Yes, you feel like you're chasing a little bit, and of course I know there's times it's going to come back and you're going to get stopped on it, but the beauty of this is, you know what, if you get a real genuine one that just keeps going and going and going, it could get you in at the start of a very, very decent trend. So I want to look at, guys, and also comments below your thoughts on this specific strategy for you swing traders out there. Let me know what you think about this one. Anyway, guys, take care, good trading. I'll see you in the next one. Bye bye.